Before investors trust your numbers, they verify every single one. And that's where financial due diligence comes in. Hi everyone, I'm Prateek Bansal, the AVP of Transaction Advisory Services at DPNC Advisors. If you're raising capital or selling your business, you've probably heard of FDD or financial due diligence. But what does it actually mean? And what are investors really looking for? In the next few minutes, let me break it down for you. Financial due diligence is the process where an investor or acquirer verifies the financial health of your business. So it's not just about reviewing revenue or profit, it's also about understanding the quality, sustainability, and reliability of those numbers. In simple terms, the investor asks, can the buyer trust your numbers? Are they repeatable and defensible? When investors begin financial due diligence or FDD, their goal isn't just to confirm what's on your P&L, they also want to understand the story behind those numbers. So they usually start with revenue and profitability. They're not just asking how much you made, but also how you made it. What's your revenue model? Are your income streams recurring or one-time? They also ask, are your margins consistent across different segments or geographies? So if they see a sudden jump in profits, they'll always ask, is this sustainable or a one-off? Next, they turn to working capital. Many businesses don't realize how critical this is. Investors will dig into your receivables, payables, and inventory cycles. If you're profitable on paper but constantly cash-strapped, they'll notice. They'll also assess how predictable your cash flows are, especially if you're a seasonal business. Then comes normalized EBITDA. And this is where investors strip out one-time income, non-operational expenses, or excessive founder salaries to get a clearer view of operational performance. Why, you ask? Because this cleaned up EBITDA is what they're actually using to value your business. Apart from this, they'll also examine related party transactions. Any dealings with group entities, family members, or promoters need to be documented, and transactions need to be at arm's length. If anything looks informal or disproportionate, it raises a red flag. Finally, they conduct a tax and compliance review as well. And this includes checking GST returns, TDS payments, and income tax filings, along with ROC submissions. A few errors might be acceptable, but repeated non-compliance can shake investors' confidence or delay the deal. Now, even promising deals can get stuck, or worse, fall apart, if certain red flags show up during the diligence. One of the most common is a mismatch between your MIS and audited financials. If monthly reporting system, if your MIS shows one picture but your audited results show another, it raises questions around the governance of the company. Another issue is documentation. So missing invoices, improperly or poorly maintained ledgers all suggest a lack of financial hygiene, and that makes investors nervous. Sometimes cases of recognizing deferred revenue too early or personal expenses running through the business also come to light, which directly impacts your valuation as well as the credibility with the investor. These things don't just delay a transaction, they can shake investors' trust, and that's often the hardest to recover from. So to wrap up, financial due diligence or FDD is more than just a financial review. It's a way for investors to understand how your business truly functions beneath the surface. It's not just about being perfect, but also about being prepared. The cleaner your books are, the clearer your story will be, and the more confidence you will create in the investor. So if you're looking at a fundraise or an exit, investing time in getting this right can make your deal smoother, faster, and stronger. Thanks for watching. Got questions about FDD? Drop them in the comments below, and don't forget to subscribe to us for more expert tips.